So for this video, I'm going to look at income tax. Okay, so let's go ahead and jump over to the whiteboard. Now, I do want to be really clear. By the end of this video, you're not going to be an accountant. You're probably not going to be able to do your own taxes or anybody else's taxes, but this just gives you a general understanding of kind of what income tax is and a general idea of how it's calculated and what it all means. Okay, so first of all, I am on the laptop, which is always messier, but I want to be able to bounce back between the calculator and a tax table. So this was just sort of the better option out of my two very limited options for technology. So first of all, income tax. And again, this is the side effect of the calculator or the computer. It's just messy. Okay. But income tax is a percentage of your income that is collected by the government to fund services and programs. So it's a percent of income, your income, collected by the government to fund services and programs. So all of the services and the programs that the government offers to people, the money doesn't just come from thin air, it comes from income tax, okay? So everybody pays their portion of income tax, and then that money goes to fund stuff, okay? Now, when you're calculating income tax, there are several different components that come up, and the first and most important is your gross income. Now, you can see from your worksheet, gross income is like your total wages. So if you have multiple jobs, it's all of the money you initially bring home. So it's like your hourly rate times the number of hours you work. It's from any job you have. It can come from tips if you work at a job where you earn tips. It can come from interest that you earn on a savings account or any kind of banking. It can come from dividends that you earn on investments. It can come from unemployment. So if you're out of your job and you file for unemployment, it can come from unemployment. Profits that you get from a business can get taxed. Rental income. So if you have like an Airbnb, anything like that, winnings from game shows, okay, the list could go on and on. So any money that you earn is going to get taxed, okay? So for this video, I'm just going to put total wages, but all of those things I listed out, those are possible sources of income, okay? So then we have something called, let me clear this notification. We have something called adjustments, okay? So the first thing you do when you're calculating your income tax is you need to know what is your income. So again, your gross income is everything. Every penny that you've earned that year is your gross income, okay? Oh, it's not adjusted, bless my heart. It's adjustments. Okay, so then there are things that are called adjustments, and they are subtracted from your gross income. Okay, so again, looking at your definitions, it's untaxed portions of gross income. Okay, now you can't just willy-nilly be like, well, I want 15,000 of my gross income to be untaxed. It's got to fit certain categories and certain criteria, okay? So some things that can be included would be contributions to certain retirement accounts that are tax deferred. So that means you pay taxes on them later, so they're not going to get taxed today. You can have interest paid on student loans and alimony payments. Those are just a few examples of what adjustments could be. Now, in the big world, there are other adjustments. We're going to look at a very small scale. So again, retirement plans, tax deferred savings, you can have alimony payments, you can have student loan payments, interest paid. It's not the student loan payments, it's the interest paid on student loans. So those are just a few things that could come up as adjustments, okay? And then you have something called an exemption. Okay, so these are just the definitions of the things that can come up in your income tax calculation, okay? So the next up we have exemptions. This is a fixed amount on your return for each person you support. So this is just a fixed amount for you and your dependents. Now, here's the thing. You have to legally support these people. You can't just be like, well, my girlfriend or boyfriend or my best friend Joe have been living with me and I've been supporting them, therefore they're my, they're a dependent of mine. That's not really the case. So children would count as dependents. People that you are legally responsible for, those would count as dependents. But again, there are legal ramifications here. It can't just be like anybody that you are financially supporting. Okay, so it has to be somebody that you truly financially support. Okay. Next up on the next screen, we then have deductions, and the deductions are probably the most confusing part of the initial calculation. There are two paths. The first is a standard deduction. Okay, the second is an itemized deduction. Again, please remember how messy this is when I use the laptop. It's just awkward writing on the laptop and then I have this crappy stylus. So, be nice. But I know that this looks like garbage. And if I write really slow, it's better, but then it just slows the whole video down. So whatever. Anyway, so deductions, it can be standardized, itemized. And what we have to do is we always have to decide which one is going to be better. Okay. As the taxpayer, we want the bigger deduction. We want our income to be reduced by the most. Okay. So you would look at all the possible itemized deductions. You would look at the standard deduction, figure out which is bigger. So I'm going to put that first. Choose the bigger option. Okay. Now, when it comes to deductions, itemized deductions can be interest that you pay on a mortgage, state income tax, property tax, charitable donations, medical expenses, but it's not just any medical expense. It's medical expenses in excess of 7.5% of your adjusted gross income. Okay. And we'll talk about adjusted gross income in a minute. So again, depending on who the person is, you may qualify for itemized deductions or standard deductions. And it kind of depends. What I have found is like a lot of younger people that, they rent a house, they don't own anything, they don't really have any kind of big accounts, they're not responsible for a whole lot, they're generally going to benefit from the standard deduction. But once you're kind of on your own, you have a mortgage, you're paying property taxes, sales tax, not sales tax, state taxes, you got a lot more going on, then you may or may not qualify for the itemized deduction. And the great thing about this is we generally can hire accountants to do this for us. In this class, in the book that we use, you will be given a list of your itemized deductions. You always want to add that up and compare it to the standard deduction that's going to come from a table. You always choose the bigger option. Okay. And again, we have a list of things that could possibly be itemized deductions. It's just a small list. It doesn't include everything. Again, this is just a sampling of what could be considered a deduction. Okay. And then you have tax credits. Okay. So tax credits are sums of money that reduce the income tax owed by the full dollar for dollar amount of the credit. So again, in the book we use, you'll be told straight up if this person qualifies for a tax credit. And basically what you do at the very end, you figure out the tax calculation and you just subtract the tax credit. Okay. So subtracted from final tax calculation. Okay. So now let's look at the actual calculation that we need to do. So steps to calculate. Income tax. All right. The first thing we have to do is find the adjusted gross income. Okay, so the way you get the adjusted gross income is you take your gross income and you subtract adjustments. So remember those adjustments, those are non-tax portions of your income. So that would be like retirement accounts, tax deferred savings plans. That could be unemployment. Let's see, profits from a bit. That's not it. Let me see. Interest paid on student loans and alimony. Okay, so that would be the tax deferred savings plans, the retirement accounts, interest on student loans, and alimony payments. Okay, so that would be how you calculate your adjusted gross income. You take the gross income, you subtract the adjustments. Step 2 And this is the hardest. I don't want to say this is the hardest part, but this part's a little bit tricky. The calculation is easy to do. You just have to be a little bit careful. You got to be really careful and precise about what you do. Okay. So the next part is determine or find the taxable income. So here's the good thing. The government isn't taxing necessarily every single penny you make. They're figuring out how much of your money they can tax. And so that's the taxable income. They want to know how much of your entire gross income they can tax. And so the first step is to figure out what your adjustments are. Those are the non-tax portions of your income. You subtract that. Once you subtract the adjustments, you then have to subtract exemptions and deductions. Okay. So it's easy at first. You do the adjusted gross income minus the exemptions. Now remember, exemptions are predetermined amounts, and you get one for you and everybody that you support. So all of your dependents. And then you get one deduction. And remember, with the deductions, so I'm going to do exemptions and deductions. With the deductions, you either get the standard deduction or you get the itemized deduction. And you always want to choose which one is bigger because you want to subtract as much as you can from your gross income. Okay, so calculating your income tax, the first thing you want to do is figure out your adjusted gross income. That's your gross income minus the adjustments. Remember, adjustments, let me go back to my list. They're untaxed portions of your income. They can be certain retirement accounts, tax deferred savings, interest paid on student loans, and alimony payments. Okay. Then you find your taxable income. Remember, you want your taxable income to be as low as possible. So you want to get that down as much as you can. So you take your adjusted gross income, you subtract all of the exemptions you qualify for. So one for you and all of your dependents. And then you get one deduction, either the standard deduction or the itemized. Choose the bigger one because that's going to reduce your taxable income by the most. Okay. And then step 3, this is really the hardest part of it, but you got to be really careful with step 2 because if you get off on step 2, it goes downhill from there. Okay. So what we have to do is figure out our income tax. So this is kind of the goal. Okay. So your income tax is the tax computation, and I'll show you this in detail. Okay. So it's not like, woo, bam, there's a tax computation. It takes a little bit of work, but I'll show you how to do it. But you take your tax computation and you subtract any tax credits. So remember, credits are the things that are subtracted from your tax computation dollar for dollar. Okay. So there's 3 big steps. Find your gross or your adjusted gross income, find your taxable income, and then find your actual income tax calculation. And we could kind of say there's a preliminary step of determining what is your gross income, because for some people, like for me, I just have the one job. So my gross income is really easy. It's just what I make at my job. For other people, they have several jobs, they have other forms of income, and they have to do a little work there. Okay. So again, find your gross income and then these 3 steps. Okay. So let's look at a couple of examples. Okay, so the first example, we have a single woman. That is important because when you go to a tax table, and I'll show you one in just a moment, the tax table breaks it down into single, married, and then married with dependents, married, no dependents. So there's different categories you file with. And so whether somebody is single or married or a widow or whatever, that does matter. Okay, so we have somebody that is single. Okay. Their wages and earnings, I'm just going to put earnings. I think that makes a little more sense. Their earnings are $87,000. That's probably their main job. They also received interest on a savings account of $2,680. Okay, and then they contributed. Okay, so that is going to be their wages. Okay, we then have to look at adjustments. Now, remember, adjustments can be, they're the non-tax portions of your income. They can be contributions to retirement accounts, tax deferred savings plans, interest on student loans, and alimony payments. And so this particular taxpayer, they contributed $3,200 to a tax deferred savings plan. That's an adjustment. So that would be $3,200. Okay. Exemptions, since this person is single and it does not show that they have any kids, they're entitled to one exemption. And it tells us here that it's $4,050. Okay. And then for deductions, this is where you have to be careful because there are two options for the deductions. Remember, there's the standard deduction and then there is the itemized deduction, okay? And it does matter. Okay, so let's see, this person, the standard deduction, I'm gonna put it down here. The standard deduction is $6,300 for this particular taxpayer. The itemized deduction, let's see what their different deductions are. Okay, they have interest on a home mortgage for $11,700. That's a deduction. They have $4,300 in property taxes. That's a deduction. They have $5,220 for state taxes. That's a deduction. And then they contributed $15,000. Let me erase that. It looks crazy. They contributed $15,000 to charity. Okay. So what we want to do is we want to add up all of those deductions and see what the final amount is. So I'm going to cheat and just really quick use my calculator. So we have 11,700, 4,300, 5,220, and 15,000. And the total for the itemized deductions is 36,220. So here's the deal. You only get one deduction. You either get standard or you get itemized. You never get both. Okay. So what you want to do is you always want to calculate the itemized deduction, find the total, and then compare it to the standard. For this particular taxpayer, the standard deduction is only $6,300. They are way going to benefit from the 36,220. So for this taxpayer, they are 100% going to take the itemized deduction. It's going to benefit them massively in the end. Okay. So this is kind of the information we have, and I'll flip back and forth from this screen, but we have earnings of just their regular wages, 87,000. And then they also had earnings. I think it was interest on a savings plan for 2,680. They had an adjustment. They had put money into a tax deferred savings plan. That was 3,200. They get one exemption. They don't have any dependents. They get the one exemption of $4,050. For the two deduction options, they had standard or they had itemized, and they have way more in the itemized deduction. So that's the one we're going to choose. Okay. So that's kind of the information. Now let's answer some questions. Okay. So the first question is determine gross income. Well, if we go back a sheet, earnings for this particular person were 87,000 plus 2,680. So that would be 87,000 plus 2,680. So this particular taxpayer has a gross income of $89,680. Okay. Got to get my Diet Coke in. All right. Next thing we want to do is calculate the adjusted gross income. We do oftentimes call adjusted gross income AGI just for short. So if I ever say AGI, I mean adjusted gross income. So let's go back. This particular taxpayer had adjustments totaling $3,200. So what we do is we take the gross income, we subtract the value of the adjustments, 3,200, and we end up getting 86,480. That is the AGI, the adjusted gross income. Okay. So the next thing we want to do is figure out the taxable income. So this is where you take the AGI and you subtract the sum total of the exemptions and the deductions. Okay. So if I go back a couple of screens, you can see it. So we're at this point right here. We found our adjusted gross income. We're looking for our taxable income. So we take adjusted gross income and we subtract the sum total of exemptions and then whichever deduction is going to be best for us. Okay. So for this particular taxpayer, they qualify for only one exemption. They don't have any dependents. So they're going to get $4,050 for an exemption. And then for the itemized deduction, that ended up being way better for this person because it was much larger. So they have an itemized deduction of $36,220. Okay. So for the taxable income, we want to take the AGI, the adjusted gross income of $86,480. We want to subtract the grand total of their exemptions. They only get one because they have no dependents. and then their deductions. And remember, this taxpayer qualifies for the itemized deduction. It's way bigger than the standard deduction, and you always give them the bigger deduction. So in this case, it was 36,220. So we're going to get 86,480 minus 40,270. So we can reduce their taxable income by a full $40,270. That's the sum total of the exemption and the deductions. And that gives us a taxable income of $46,210. And your goal as a taxpayer is to make your taxable income as low as possible. And that's why we hire those really good accountants. They find all those deductions and things that we qualify for. Okay. So that's the easy part. You just have to be careful with your deduction, but that's the easier part. The weird part comes next. Okay. So I'm going to stop sharing for just 1 second. So next up, we have to do the actual tax calculation, and we're going to do it for a different taxpayer. I just wanted you to know how to set all this up. So for the next problem, we're going to do the whole shebang. We're going to figure out the gross income, the adjusted gross income, taxable income, and then we're going to do the actual tax calculation, but you need a tax table. So let me pause really quick. I'm going to get the tax table ready. Okay. Okay, sorry, I had to get the tax table, and then I got like 87 text messages in the first part of the video, and it was stressing me out. Okay, so let me show you the tax table. So this is a standard tax table, and notice it has the tax rate in the first column. So basically what happens is you have this taxable income, and your goal is to get your taxable income as low as possible. And then certain portions of your taxable income are taxed at different rates, okay? So if you look at this second column, and then the third column, the fourth column, and the fifth column, so like the last 4 columns, they give you the filing status. So the first of those columns is single. So this means you're unmarried, divorced, or you're legally separated. The next one is married but filing separately. That means you're married, but each partner files a separate tax return. The third filing option is married filing jointly, and that means you're married and both partners file a single tax return. And then the fourth option for filing status is your head of household. So that means you're unmarried and you're paying more than half the cost of supporting a child or a parent. Okay, so the child or the parent that you're spending more than half of to support, they become a dependent. Okay. So the tax rates, if we go back to the first column, the tax rates are 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. Different portions of your income are taxed at different percentages. So most of us never get too far on this list because we don't make that much money. So like if you notice here, just looking at a single person, the first $9,275 of their income is taxed at 10%. Up to after the 9,275, anything from basically 9,276 up to 37,650, that's going to get taxed at 15%. After the after 37,650, we would have $37,651 all the way up to $91,150. That chunk of your income is going to get taxed at 25%. And it just keeps going. So basically they're taking your income and they're breaking it up into chunks, and each chunk gets taxed differently. You don't get taxed a penny higher than your taxable income. So if your taxable income only goes up to $40,000, then anything from $37,651 up to $40,000 gets taxed, not a penny more than that. Okay. Sorry, I haven't talked that much today, so I'm a little scratchy. The last 2 rows of the table are your standard deductions and your exemptions. Okay. So if you notice the exemption per person, it's $4,050 no matter what. So every single taxpayer qualifies for $4,050. And then remember, if you have dependents, then you also get an exemption for each dependent that you have. The deductions vary. Okay. Hold on. I hate when this happens. So the deductions vary. So notice if you're single or marrying filing separately, the deduction is exactly the same. Then if you look at married filing jointly, the deduction is really the same. You just get the $6,300 for each of the 2 taxpayers. The only one that's really different is when you're the head of household. So you're unmarried, but you have dependents. That one gets a bigger standard deduction. But remember, for the deductions, you look at the standard deduction here, then you also look at itemized and you choose the bigger one. Okay. Just make sure you kind of know how to read this table. All right. So for now, I'm going to go back to the whiteboard and we're going to do this whole process over. We're going to find a new person's taxable income, and then we're going to find the tax calculation. So we're done with this person. All we wanted to do was find their taxable income. We're going to meet a new taxpayer now. I really am sorry, but I don't want to stop and start this video over. So, oops. All right. So the directions for the next problem is calculate the tax owed. So we're going to do the whole shebang this time. And we have a single man, no dependents. So single, no dependents. We are told that the gross income, I'm just going to call it GI. The gross income is $40,000. We have an adjustment for this particular taxpayer of $1,000. When it comes to the deductions, they're not going to tell you the standard deduction. You go to the table to find the standard deduction. They're just going to tell you the itemized deductions. And then also for the exemption, they're not going to tell you how many exemptions they qualify for. You go to the table and then you determine if they have what their deduction is going to be or their exemption is going to be. And then if they have dependents, you get one for each of those. So this particular person, they're going to get just the one exemption, and then we're going to compare the deductions in just a minute. Okay. All right. So for the deductions for this particular taxpayer, they donated $3,000 to charity. They had a $1,500 theft or loss. And then they had $300 cost of tax preparation. Okay. So those are two extra things you can add to your itemized deductions: theft and loss, cost of tax preparation. Okay. So let's go really quick to the tax table. Remember, this is a single person, no dependents. So if we go down here, right here, you can see the standard deduction for somebody in the single column would be $6,300, and the exemption is $4,050. Okay. They have no dependents. They only get one exemption. So let's go back to the whiteboard. So for this particular taxpayer, they get one exemption of $4,050 and the standard deduction of $6,300. So let's figure out what their itemized deduction is. Okay. So this taxpayer has $3,000 plus $1,500 plus 3. So their standard deduction is $6,300. The itemized deduction is $4,800. Always choose the bigger deduction. In this particular case, this taxpayer is going to benefit by getting the standard deduction. It's actually bigger. Okay. So far they get an exemption, they get a deduction, they have an adjustment. Let's do all the calculations. Okay. So first we want to know what the adjusted gross income is. Adjusted gross income is 40,000 minus the adjustment of 1,000. So the adjusted gross income is 39,000. Okay. Now the second thing we want to do is the taxable income. So the taxable income, I'm going to call it TI for short. Okay. The taxable income, we take the AGI, the adjusted gross income, and we subtract the sum total of exemptions and deductions. This person has no dependents. They get only one exemption. And we already did the calculation on their deductions. The itemized deductions came up to 4,800, but the standard deduction for this taxpayer, 6,300, always take the bigger deduction. So this taxpayer, we're going to give them the $6,300 deduction. So their taxable income is going to be 39,000 minus 10,350. So if you take the 40,50 and the 6,300, that adds up to 10,350. So the grand total for their taxable income is going to be 28,650. And just so you know, I cheated and I did these calculations ahead of time. If you want to pause the video or slow it down, you can do that. But I would say at this point, if you're a little behind, pause the video, make sure your calculations work, go from there. Okay. I'm getting text messages again. So while you're pausing, let me see if somebody desperately needs me or not. No, they do not desperately need me. Okay, so now we want to do the actual tax calculation. And this is the weird part. Okay, this is the hardest part. Remember, basically what we're doing is we're taking everybody's income and we're breaking it up into chunks. Each chunk is taxed at a different tax rate. Okay, so let's go look at the tax table for this particular taxpayer. The first portion of this taxpayer's income is going to get taxed at 10%. So the first portion of the income goes up to $9,275. So the first $9,275 that this particular taxpayer earned, it's going to get taxed at 10%. And remember, in math classes, when we're given percentages, we actually put them into our calculations as decimals. Okay, so the first portion of this man, I think this is a man, anyway, this taxpayer's income, it's going to get taxed at 10%. Now, anything after 9,275, those chunks get taxed differently. So let's go back to the tax table. So if we go back to the tax table, we can see that anything from $9,276 up to $37,650 gets taxed at 15%. But remember, this particular taxpayer, their taxable income was only $28,000 and something. So they're only going to get one more portion to this calculation. So we're going to go 9,276 and then any number up to 37,650. So let's go see what our taxable income here is 28,650. We're not going to tax them a penny more than 28,650. So what I want to do is I want to take the 28,650. I want to subtract what has already been taxed. We've already taxed 9,275, and we're not going to tax it again. It's already been taxed. But this new value, it's going to get taxed at 15%. So let's see what this ends up being. So we get the 9,275 taxed at 10%. So that's going to be $927.50. And then the 28,650, that's the taxable income. We want to subtract the 9,275 that's already been taxed. We're going to figure out what that is. That's going to get taxed at 15%. So if I do this subtraction here, the 28,650 minus 9,275, I end up getting 19,375 times 15%. So let's see, that's going to be the 927.50 for the first chunk of the income. The second chunk, if I do this $19,375 at 15%, that's going to be $2,906.25. The sum of those two becomes $3,833.75. So that is how much this taxpayer would owe the federal government at the end of the year. Now, here's the thing. This number one taxpayer, they did not have a tax credit, so that's what they owe. But here's the thing. You don't just have to suddenly cut a check to the federal government for $3,833.75. No, what's happening is throughout the year, your employer is estimating what your taxes are going to be. So every week, every 2 weeks, every month, however often you're paid, your employer is taking money out of your paycheck and they're sending it straight to the federal government. So then at the end of the year, what we have to do is we have to figure out how much we owe, which is what we just did on paper. But then we also have to figure out, what did we pay? Did my employer overestimate my taxes or did they underestimate my taxes? So if you ended up paying more throughout the course of the year than $3,833.75, then the federal government owes you a refund. They're going to give you the difference back. However, if your employer wasn't taking enough out, and at the end of the year, you didn't quite pay $3,833.75, that's when you have to cut a check, and you only cut a check for the difference. So again, this amount right here could be panicky for some people. Like if I had to come up with $3,833 right now to give to the federal government, I'd have a heart attack. But throughout the year, my employer would be taking portions of that out each paycheck. So by the end of the year, I should either be right at that or really close, so that one way or the other, I'm not having to pay too much difference. Okay. So that's how the tax calculations work. All right. Let's do maybe one more of these. So your worksheet ends with that example, but I think I want to do one more calculation where we start from beginning to end. And then, so it's not on your worksheet, this is just extra practice. You can skip this if you want. Then we'll start looking at FICA taxes and then how to calculate just a regular paycheck. Okay. Okay, so I had to dig and find a good example. So let's do one more example where we do a full tax calculation. So we're going to find the AGI, we're going to find the taxable income. Let's see, we're going to find the actual tax calculation. So we're going to do from start to finish the whole thing. Okay. So let's go to the whiteboard. I keep pausing this video. Sorry, I've been getting so many text messages. All right. So here's our example. We have a single head of household. And they have 2 dependents. Okay. Their gross income is $172,000. Okay. Now, there are some other things that are going on. They do have one adjustment for $2,500. Okay. And then as far as deduction, remember, deductions go, we want to add up the itemized deductions and always compare it to the deduction, the standard deduction in the tax table. So as far as the deductions for this taxpayer go, deductions, they had mortgage interest of $10,000. They had property taxes of $2,500. They had a $1,200 charitable contribution, and then they had $500 for tax preparation. Okay. Now, this taxpayer also has a tax credit of $275. Okay. So this is going to be a little different than the other example that we did. So the first thing we want to do is we want to calculate the adjusted gross income. Luckily, this person already just had a calculated gross income, so we didn't have to go figure it out, or maybe they only had the one job and that's their salary for the year. So we didn't have to do any work to figure out their actual gross income. It was given to us, but we do have that they have one adjustment of $2,500. So we take the $172,000, we subtract the $2,500. And so for this particular taxpayer, their adjusted gross income is $169,500. So that's the adjusted gross income. What we want to do now is figure out their taxable income. So the taxable income is important. That's how much the government's actually going to tax of your total gross income. And so you want to make sure you get all your deductions, all your exemptions correct. Okay. Now, the way we do this is we take the adjusted gross income. Well, that looks really stupid. Let me fix it. We take the adjusted gross income, we subtract all of the exemptions. Okay. Now, we need to go to the table. We need to see what the exemptions are. And remember, taxpayers get an exemption for themselves and each of their dependents. Okay. So this person's going to get more than one exemption. So let's go to the table. Now, this person is single, but they're head of household. So they qualify in this 4th column here. So we want to go and look at the deductions and the standard exemption. So the standard deduction and the exemption. In this particular case, the exemption is just $4,050, but this taxpayer gets 3 of them. They get one for themselves and then one for each of their dependents. Okay. So this taxpayer, they're going to get 3 times the 4,050. Okay. Now let's figure out their deductions. So first of all, let's add up their standard, their itemized deductions. Let's figure out everything that they have that can qualify as a deduction. They had the $10,000 in mortgage interest. They had $2,500 in property taxes. They had a $1,200 charitable contribution, and they had a $500 tax preparation fee. So their itemized deductions are $4,200. Okay. Let's go back to the tax sheet and let's see what the standard deduction is for a head of household. Okay. With dependents. So remember this 4th column, it's the head of household. So that means you're unmarried and then you've got dependents. The standard deduction for this taxpayer is $9,300. So we want to go back to our calculation. The itemized deduction was $14,200. The standard deduction was $9,300. You always give the bigger deduction to your taxpayer. So for this particular taxpayer, we're going to give them the larger $14,200 $200 calculation. Okay, so we take 169,500. Let's figure out what they can subtract. So that's going to be their 3 exemptions. So we're going to do 3 times 4,050 plus 14,200. So we get to reduce their income by 26,350. So their taxable income is going to be $143,150. So that's the taxable income. That is the number that we're going to use for that table. Okay. So make sure you've got this. Pause the video if you need to. Make sure you've got all this written down. Make sure your calculations match mine. And then we'll go to the next page and we'll do the actual tax calculation. Okay. So remember, their taxable income is $143,150. Okay. Let's go to the tax table and we're going to look at their first tax rate and we're going to see what that's going to end up being. And we're going to keep going back to that table until we get all $143,150 taxed. Okay. So remember, we're in the 4th column because we have head of household. And the first portion of their income goes up to $13,250. And that's going to be taxed at 10%. Okay. So we get $13,250. So we get $13,250 and it's going to get taxed at 10%. I think I might have said 15%. I was definitely a liar, pants on fire. This gets taxed at 10%. Now let's see what the next cap is, like the next interval. So the next interval of their income goes from 13,251 all the way up to 50,400. Okay. So we're going to take up to 50,400. We're going to subtract what's already been taxed. We've already taxed $13,250. We're not going to tax that again. But this new interval, this new portion of the income, it gets taxed at 15%. Okay, let's go back to the table because we still have income to tax. So the next interval, if you look here, the 25% tax rate, that for this head of household taxpayer goes all the way up to $130,150. And our taxable income is within that range. So we're then going to take $130,150. We want to subtract what has already been taxed. We've already taxed $50,400. So we want to subtract that. We don't want to tax that portion again. And this portion of the income gets taxed at 25%. Now remember, we've got to go all the way up to $143,150. So we need to do at least one more calculation. So let's see. Since we made more than $130,150, we're going to go all the way up to the 28% tax rate. And so that portion of the income goes anything from $130,151 up to $210,800. Well, we're not, or $210,800. We're not going to go all the way up to $210,000 because we don't make that much. We're going to go up to exactly the $143,000 whatever that we made. Okay, so that again gets taxed at 28%. Okay, so we can go all the way up to $143,150. We cannot go a penny higher than that, but we don't want to tax all of that at 28%. We only want to tax the extra part that we haven't taxed yet. We've taxed up to $130,150. So subtract that, and then this little portion gets taxed at 28%. So I'm going to clean this up. We get $13,250. That's getting taxed at 10%. The next portion of the income is going to be $50,400 minus $13,250. So the next $37,150 of their income gets taxed at 15%. And then we go $130,150 minus $50,400. The next $79,750 gets taxed at 25%. And then finally, we're almost there. I want to make it a little smaller so I can fit it all in if possible. So then finally we go up to 143,150, but we want to subtract everything that's been taxed. We've already taxed $130,150. So the last $13,000 of their income gets taxed at 28%. So let's do all the percentages and then add them up. Are you ready? This has been a lot of talking. Okay, so 13,250 times 0.1 is 1,325. 37,150 times 0.15 is $5,572.50. 79,750 times 0.25 is $19,937.50. And then finally 13,000 times 28% or 0.28, that is 3,640. Now what we want to do is we want to add all of this up, and that's going to be how much tax this taxpayer would owe throughout the year. So I get 1325 plus 5572.50 plus 19,937.50 plus 3,640, and this taxpayer has to pay a whopping $30,475. But remember, they had a tax credit. So we're at this point right now. We have the tax calculation, but this particular taxpayer has a tax credit of $275. We don't know what for, they just have a tax credit. So what we want to do is take their tax calculation, which is right here. So we've got the $30,475. We want to subtract their tax credit, which was $275. So that tells us this taxpayer owes this amount right here. But remember, they don't have to just all of a sudden cut a check for $30,200. Their employer, each paycheck, has been taking a portion of their income out and sending it directly to the IRS. Okay. So then, excuse me. So then they're paying this throughout the year. At the very end of the year, we want to figure out how much they paid, and we want to compare it to this. So let's say that throughout the year, they ended up paying more than $30,200. Well, they'll get a refund for the difference. If they paid less than $30,200, then they owe the federal government the difference. Okay, so that's kind of how the income taxes work. So remember, you can rewind this video, you can watch it several times, you can read up in your book and look at examples in your book. Make sure you understand the basics. Any kind of test or assessment you will have a tax table given to you. You don't have to memorize the tax table. Okay, so back to your worksheet, we have a new definition. We have the FICA taxes. Okay, so FICA taxes, it stands for Federal Insurance Contribution Act. And basically the FICA taxes are used for Social Security and Medicare. And you have a new tax table, but this one's actually included in your worksheet, okay? So for this particular situation, you have an employee's rate, you have matching rates paid by the employer, and then you have the self-employed rate, okay? So we're gonna look at an example of this. Now this comes from 2016, so this tax table is a little bit outdated, but I think we'll get the gist, okay? So we have an example. You are not self-employed and you earn $200,000. What are your FICA taxes, okay? So example, not self-employed. That means you work for somebody. So not self-employed. And you have wages of $200,000. Okay, so here's how the FICA taxes work. If you look at the tax table, the very first column, you pay 7.65% for the first $118,500 of your income. Anything in excess of $118,500, you pay 1.45%. Okay, so we get $118,500. That portion of your income gets taxed at 7.65%, so 0.0765. Now, anything in excess of that, gets taxed at the lower 1.45% rate. So we want to take our total income, 200,000, subtract what's already been taxed, which is the 818,500, and that's going to get taxed at 1.45%. Okay, so 118,500 times 0.0765, that is $9,065.25. Now the 200,000 minus 118,500, that ends up being 81,500. That's going to get taxed at the lower 1.45%. So then that's going to get taxed at 1.45%, which is $1,181.75. So your total FICA taxes for a year where you made $200,000 would be the sum of these two things, and this would add up to $10,247. And that's it. Okay, so that's what you'd have to pay in your FICA taxes. That's what you're paying towards your Social Security, and ideally, when you are old enough and you apply and you are warranted Social Security, that money will still be there. Okay, so the FICA taxes, it's, I think, an easier calculation than the actual tax calculation. So if you can do the tax calculation, you should be good to go on the FICA. Okay, now the last thing we want to do is we want to look at how to calculate your actual like weekly or monthly income. So calculating your paycheck. And this is probably what most of you are interested in. We should have almost started here. Okay, so we have an example. The best way to do this is just go into an example. And what I find is students are generally pretty good at this because a lot of times we've been calculating our own paychecks because we need to know what's coming our way. So we're generally pretty okay at this. We're just going to make it a little more technical. Okay, so it says you decide to work part-time at a local nursery. I've had debate over, is this a nursery where you're dealing with plants or children? I don't know, nor do I totally care, but I have wondered. Okay, you get paid $16 per hour. You work 15 hours per week. Okay, that's super important information. We also know that you withhold 10% for federal taxes. So your employer takes out 10% of your paycheck. They send it to the federal government. They then take out the 7.65% for FICA taxes. That goes straight to the government. And then they're going to take out 4% for state taxes. That goes straight to the state. Okay, so let's figure out how much you get to take home. Okay, so first of all, we want to figure out your gross income. So for the week, we're just going to do 1 week. So for 1 week, you would make $16 an hour for each of your 15 hours. So if we multiply that out, you should get $240 as your gross income. Now, tragically, you don't get all that. The government gets a big old chunk of that. You get what's left over. Okay, so let's figure out all the different taxes. So the first thing we want to do is figure out the federal tax. So the federal tax, we want to take our gross income, and our employer took out a whopping 10%. That's their estimation for what you're going to owe the federal government at the end of the year. So we're going to multiply that by 10% or 0.1. And that means we're going to pay $24 this paycheck on just the federal taxes. Okay. We then want to do FICA. So your FICA tax, that is going to be 7.65% based on the gross income. So you go back to the 240 and you do 0.0765. Type that bad boy into the calculator. And we get that you're going to owe FICA taxes of $18, and pretend that looks like an 8. I just made it worse. Dang it. So you're going to be paying FICA taxes of $18.36, but that's not it. You still owe the state $240 times 4%. So 240 times 0.04, you're going to owe them $9.60. So how much do you, the employer, or the employee rather, get to take home? So your net pay, that's what we call what your take-home pay is. Your take-home pay, we call it net pay. It's going to be 240 minus the sum of all of your taxes. So it's going to be 240 minus, let's see, 24 plus $18.36 plus $9.60. You have to pay out $51.96 in taxes, which gives you your take-home pay of $188.04. So that is your take-home pay. Okay. So you started out with $240 as your gross pay. You gave $24 to the federal government. You gave $18.36 to the federal government for your FICA taxes. You gave $9.60 to your state for state taxes. You took all that away. You got to take home $188.04. Now, the last question that you will be asked is, what percentage? So what percent of gross pay is withheld for taxes? And then we're told round to the nearest 1/10 of a percent. Well, you could do this two ways. We knew that 10% was coming out for federal, 7.65 was coming out for FICA, 4 was coming out for state. So if you get 10 plus 7.65 plus 4, you get what? 21.65%. Whoops. Hopefully you can see the whiteboard. I'm not sure what I did, but we get 21.65%. If we round that to the nearest 1/10 of a percent, we would say 21.7% of our pay goes to taxes. The other way you could calculate it is go back and figure out how much came out just for taxes. We took out $51.96 and send it off to the government for taxes. So we could take the $51.96 divided by our gross pay, which is $240. So you can take the amount of taxes, $51.96, divided by your gross pay of $240, and you get 0.2165. Now remember, that's the decimal version. We want the percent version, so we just move our decimal over twice, and we get 21.65%. If we round it to the nearest 1/10, we get 21.7%. Okay, so either way you calculate it, you paid out about 21.7% of your net pay, or your gross pay went to taxes. You subtract that, and that becomes your net pay. Okay, so just a quick recap. If we go all the way back, we talked about what is income tax, what is gross income, what are adjustments, what are exemptions, what are deductions. And remember, deductions, you have the two paths, either the standard deduction or the itemized. Always take the bigger. We talked about what tax credits are. We looked at how to calculate the adjusted gross income, how to find the taxable income, and then how to calculate the actual income tax. We looked at an example where all we were asked to do was find the taxable income. So we had a single woman, her earnings, her adjustments, her exemptions, and her deductions, and we came up with her taxable income. We did a second example where, is this the same person? Yeah, that's the same person. We then did a second example with a single person, no dependents. We did their calculation. We then did a second or a third example, really, where we had a single head of household with 2 dependents. We did their tax calculation. All right, so there it is. There's the rest of it. And then we talked about FICA taxes. That's the Federal Insurance Contribution Act. Okay. And then finally, we did calculating your own paycheck. I know that this was super messy. Okay. But it was easier to be able to switch back and forth to the tax table on the laptop. So it was messy. I'm sorry about that. Just know I love you. Okay. Anyway, that's it for this video. Hopefully it's okay. Ask questions when you see me. All right. Take care.